Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 24th, 2016 edition of Market Outlook. So we had a week of digestion, but positive upside action. We've got a pretty good situation overall. A couple areas of concern, which we'll point out as we go through this week's video. So, a couple things to note. First of all our key indices ended up positive on the week, putting them all as well positive up on the year. So overall, a really good sign. And not only that, we really punched out to new highs the prior week, and the digestion actually resulted in a positive week. So sideways to up action after a breakout to new highs in some of these indices, I see as a net positive here. Now, furthermore, in terms of volume, even though we've had a relatively low volume for this week, the accumulation days definitely are outweighing any distribution days over the last couple of weeks. And as you can see, even in NASDAQ, we've had no distribution, accumulation days. Accumulation days, just to review, are where today's volume on an up day is greater than the prior day. And the inverse is true too for distribution. We like to see 4 accumulation days over a 2-week period to know that the institutions and the bigger hedge funds are playing on the long side. And basically, you're getting that. So I see this as a pretty good positive, although in a couple of the indices, you can see that it's 3 accumulation days over the last couple of weeks versus 2, not quite as strong. But net, if you balance it out, you got a positive. So overall situation here, looking at the week's action, year to date, all pointing positive. Okay, let's take a look at what's happening with the sectors. Our sector page is even more positive, and I'll show you why. First of all, as you can see, right here, right, you've got basically the market, the S&P, closing on all new time highs. And look at this. This graph here shows how many sectors are positive versus negative. And you can see right here, all of our market sectors making up the U.S. economy, all in positive ground, quite a bit different from several months ago and even several weeks ago. So you've got a real positive situation overall in the sector confirmation, which is looking at how many are up, how many are down, and as you can see, this year, virtually all of our sectors are up year to date, except for financials. Let me point that out over here. Okay, year to date, the only sector that's down is financials. All the others are positive. Now, a couple of other things to point out in this section over here, looking at sectors. First is semiconductors, right, which is a sign of more speculative and a growth industry looking very, very strong. There were some buyouts that affected this. So this now pushed up to the #1 sector that is leading this rally. And of course, utilities still very, very strong. We actually picked up on an upgrade of Exelon and a couple of other ramifications from that, shot the utilities back up again. So overall, with semis and utilities both moving up, basically you got a situation where people are looking for performance, yield. They're just looking for anything in this extremely low interest rate environment. Now, a couple of things that also occurred to take note. Retail, which is really 70% of the U.S. GDP, up 1.7% this week, although it's been lagging, right, which was a concern. The fact that we did pick up and we potentially could get some more follow through would be a good sign overall. But again, everything pretty much over the last 6 months, as you can see, have positive returns. That is really good, and all sectors are firing and following through in general. So that is overall a positive sign. We definitely want to see retail and healthcare really pick up and get into better phases, right? You can see retail is still in an accumulation phase where everything else is in a bullish phase. So we would really like to see what's considered the biggest part of the U.S. economy really follow through here. And that is one area of concern. But net, I'm looking at this whole area of sectors as extremely positive to the overall risk-on environment. Okay, let's take a look at our next section, market hotspots. Just look throughout the world and see what's happening. Okay, so first of all, what is interesting is you can see that the metals, right here, even though it's been the hottest, right, up 121% over the last 6 months, metals and mining, specifically gold, these got hit this week, cooling off a bit over, right, the 6-month period that has just been basically on fire. Now, one thing for concern is you can see long volatility down quite a bit this year as the market hits new highs. We're going to get more into the market internals because that is one of the things that's pointing to a potentially overheated market. So is trend and overall situation with sectors sort of a positive? Yes. One of our concerns is volatility, and you can see it got really smacked this week, down 4%, which is not surprising as the market hits new highs. Now, what is also interesting is Latin America up 2%. So this is a commodity-based type of economies, a lot of emerging markets there, and actually they did quite well. So what's interesting, emerging markets continue to do well overall, and led by Brazil. So interesting to see that, even as gold and gold miners slip during this move to new highs. And that is really the big thing to point out. And again, searching for yield, utilities got a nice boost on Friday with some upgrades, analyst upgrades through Deutsche Bank and some others. And so you got a pretty decent sized rally on Friday, up 1.29%, which is pretty good for utilities to begin with. And that's the overall scenario. And let's get into some of the market internals here and see what they're showing. Okay, so taking a look at the spiders and the advances versus declines and up-down volume, which is sort of a key way to look at overall market internals, see if they're following through, overheating or lagging here. And as you can see in this particular chart, this first chart here, the upper chart, is up-down volume. So you can we had really good volume on the breakout to new highs, but over the past week or so, you can see we've really fallen off. So that, you know, when you hit something from an overbought level, start selling off, you can get some pretty mixed results. And certainly, as you can see, back at this point in time over here, we got pretty overbought coming off of these lows, but it worked itself in a slightly up to sideways fashion before hitting another sort of close to oversold levels on sort of 2 out of the 3 indicators. So it's not always an overbought situation is not always a sign of super overheated. In fact, the fact that we went sideways without a sell-off is pretty interesting as well. So here's what I would be looking for, and you can always go to this website, follow up, and see where these indicators are, because that will definitely help time your entry. So one of the things I want to point out is I like to see at least one of these three indicators break this dotted line, which is the midpoint on each one of these indicators. So this is the McClellan. Again, we got overbought coming off of these lows here, and we have not crossed the midpoint, and that's that 0 level here. So overall, running a bit rich, correcting. It could be a positive that the sideways correction to up is the amount of correction you're going to get. So again, key thing, used price action to confirm what these indicators are saying. So overall, if this thing breaks the 10-day moving average, I'd be really cautious, certainly lock in profits or even attempt some short plays as well. Or potentially, if we break out again to new highs, that could be what you saw over the last week and a half or so. The sideways to up action could be the full correction. So, right, price action below that 10-day moving average, which comes in about 215 or so in the S&P, would definitely give me a pause here and a reason for concern. And again, any one of these indicators starting to break the midpoint where the dotted lines are reasons for concern. Now, again, overall breadth, we got, in terms of advances versus declines, we got pretty rich, a little overheated, backing off. But again, I really would like to see this. Two things happen. Break that 0 line here, the midpoint of this indicator, and also confirmed with the price action. So that would tell you that this market, which is potentially overheated, definitely getting a needed correction, which could set up for another buy opportunity. So overall, again, the bigger picture in the background was positive sector movement, positive accumulation, distribution overall, with this possible overheating on a shorter term basis. Let's take a look at what NASDAQ is showing us in a similar type of chart. So you can see very similar readings with the composite. Sometimes you do get quite a divergence. Now, as you can see, right, we did get really good up-down volume and the correction, and actually held that 50 or the midpoint in terms of that volume. So that's a good sign. NASDAQ closed up pretty strongly on Friday, and again, have not taken out the highs. So the fact that we backed off and we're close to flipping down beneath that midpoint is a reason for concern. I would look for the NASDAQ to be the lead indicator on a potential sell-off. And again, follow that 10-day moving average. And again, similar scenario across the board. We're still well above the midpoint in all these indicators, even though we're running overheated. And obviously, the sideways but up correction is generally considered a positive. That is overall net. I'm looking at this as sort of neutral, right? And if we can follow through, I'll call that a positive, because this will now turn up and that would resume its positive trend in the market internals and along with price action. On the other hand, a sell-off below these levels would definitely give me, those 50 point here, or the midpoint in these indicators, as well as a break of that 10-day moving average. Okay, let's take a look at a couple more indicators here. And again, what we're seeing is really overall very supportive to the market. This is new highs, new lows. When we're strong and well above the 70% and even above the 85, that's just showing real strength. There's no weird divergence here. If anything, it's just showing you that this is nothing but strength. Again, we'd want to see this turning down and getting below at least some of these critical levels here. We're not even close. So new highs, new lows, confirming the overall condition of the market. Let's take a look at what NASDAQ is telling us, and exactly the same scenario. Can't argue with this. We're getting nice confirmation on market internals across the board. And this one, new high, new lows for NASDAQ, really strong. All right, so I mean, pretty much, you got the picture here. Retail is starting to pick up. We would like to see that turn into a stronger rally. We definitely want to see retail and discretionary consumer spending sectors move up. They've been the laggard, and it's very possible that we'll see some follow through there as well. However, if we don't, we're going to let the market dictate what we do. And again, markets seem to be looking for yield, performance anywhere. But overall, U.S. markets looking quite positive overall, with the exception of some overheating in terms of the market internals. And let's take a look at a couple more charts. Let's look at some sentiment indicators as well. So first of all, what's interesting on this is, and again, here's the concern, right? Market internals potentially overheated. Now, not surprising, we're on pretty close to multi-year lows in terms of the VIX, which is supportive to the market. Now, because of the blowout after Brexit, the Bollinger Bands are still very, very wide. And we like to use the Bollinger Bands as a measure of extreme optimism or pessimism. But because of the Brexit blowout, they're sort of distorted. But on an absolute level, we're certainly trudging towards the lower end. Has the VIX been lower? Absolutely. But we are definitely trudging towards the bottom. I would call this more of a neutral to a positive overall, unless we really explode down to new lows and in this VIX, and that would be an indication of extreme optimism. Right now, in just looking at the absolute value, it's not surprising we're at the lows where we should, because we're on absolute new highs. But again, we have been lower, so it's not extreme, and certainly with the recent volatility spike, we've got a bit of a distortion looking at the Bollinger Bands. So let's go to another indicator, looking at short-term versus long-term, and hold on. And in this particular case, you can see, again, we're running probably at the highest level we've been, right? We're certainly above, right, the upper line here. That's pretty extreme. But again, we really have to turn down and take out, I would say, the last swing low of that red line. So you're talking about a couple of days potentially of a reversal of this ratio, right? This is looking at short-term versus long-term, longer-term 1 month versus 3 month volatility. We're running really optimistic here, but it continues to move forward. So we're not going to anticipate a turnaround until it occurs. And again, we're going to definitely want to make sure that the 10-day moving average is violated, along with a reversal of this. In this one, I would call this particular indicator, looking at sentiment or volatility as our sentiment indicator across both, more of a neutral over here, right? Because we are running rich, and the chances are that we can get a pretty decent sized sell-off based on this particular indicator. But longer term, of course, the overall trend looks pretty strong and intact. So, sum it up, overall position for the market, extremely positive. We're running a little bit overheated. We could get that late July or August sell-off over the next couple of weeks. As you can see, sentiment is overall frothy, and extremely positive. Okay, have a great weekend, rest of it, and see you next week. And stay frosty, because again, these markets with all the geopolitical tensions, terrorist attacks, can be pretty dicey. So far, markets haven't reacted to that, but at any time they could. So again, see you next week. Thanks, and bye for now.